Hey everyone, hope you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions as we go through it, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in, take a look, see what's going on. Uh, if you want to follow me, it's at Finding Square Finance. If you want to join our community, finding-value.com, we do have a special going on. Special is the coupon code where you get 50% off the first month and a larger discount on the yearly membership if you'd like to join. We have a 5 p.m. question and answer session coming up on Sunday. Joseph Brown, he said something that I completely agree with. It says, so far, all we've seen is minor holes being plugged. Forget all that. If you want to fix the problems for good, fix the source. That's root cause problem analysis here, and it's abolish the Federal Reserve. Eliminate every bank regulation and subsidy, outlaw government bailouts of any kind. Let's just go straight to the source and knock it out. Now, that's really what the root of this cause, in my opinion, the root cause of everything is being able to create currency from nothing. So if you abolish the Federal Reserve, you want to have something to limit the currency being created. And there's no way that you can just increase it for no reason at all. And that will, I think, fix 90 something plus percent of everything. Because if someone wants to do something, like if they want a program, they have to raise the money. And if you're blocked by raising the money, then the program may not go through. So essentially, you're just blocking everyone from these stupid programs. And you block all of government from funneling money through all these programs. So I think the root of the problem is the ability to print money and then the ability to expand it. So you have to limit what it is and then like back it by something or do something, make maybe money gold and silver like it says in the Constitution, and then just abolish all this other crap, all these middlemen. These all need to go away. Rock bottom entries, something big is brewing in uranium. The ETF signals are massive multi-year breakout in 2025. We've got a 3-year cup and handle pattern cup to handle, and we are up against resistance trying to break out. A lot of people are getting really frustrated with uranium. The one thing I'll say is I don't understand uranium investors very well. If you guys are pro uranium, just stick with it. Just like think of it as a 30-year investment. You're in it when we go through problems with fossil fuels, which will definitely happen probably in the next 5-10 years. We're going to have to go to uranium. There's not really that much of an option. We're going to go small modular reactors. We're going to have to produce way more electricity. We're going to have to build out our networks. This is all going to happen. The problem that people get is they're trying to trade this big trend. And it's not, uranium, it's not a fast mover in terms of how fast it cycles. Bitcoin and Ethereum cycle very quickly. They run through their cycles really, really quick. Uranium runs like these really long cycles. So if you're going to play it, expect to be in it for a long time. I've been in it for about a little less than 5 years. I put my positions on in 2020, and I'm just going to ride it. With the money I've got in there, I'm just letting it go. Giovanni says international oil rigs ex North America is down 4 month over month to 667 in January. Europe was down 2, Middle East was up 14, Africa unchanged, Latin America down 6, Asia Pacific down 10. So Middle East is where it's growing, everyone else is cutting. And we are down on rig count substantially from the middle 2010s. Substantial move lower. Microsoft, so North Star says Microsoft versus gold breakdown accelerates. Now below key support and 4-year moving average. This is a huge warning sign, just like last time. I don't consider it a warning sign. I mean, it's a warning sign if you own tech and Microsoft. I see this as one of the biggest opportunities because this double top here, it started in 2020. We had one last top. It's a double top. Looks like it started here in 1998, 99. This is where your commodity to stock ratio bottomed, commodity to stock ratio bottomed. We're going to start to see commodities outperform stocks, stocks being the S&P 500, Microsoft, NASDAQ, whatever, Wilshire Index, all those things. So you're going to see gold break it first, which it's doing, and then commodities all come after. I just want everyone to understand this. This is a long-term play. This isn't trading it over months or weeks. This is holding it for years. And this move from here to here, there were companies that did 100 baggers, 200 baggers, 300 baggers, 1,000 baggers from bottom to top. We are just coming out of the bottom. If you go and you look at a lot of the technical analysis on the companies themselves, they're putting in gigantic inverse head and shoulder bottoming patterns in some of these commodity companies. They are gigantic, gigantic. What does that mean? It means that when we cycle through this, when however long this thing takes to cycle through like we did back here, it means those companies are going to be coming off the biggest bases that I've ever seen. It means that we're going to see moves that people can't imagine right now. And the way that you make money is that you imagine a future that others cannot imagine. You go into areas where people are not, and you buy it all up, and then you wait for the herd to come in and buy your shares. That's how it works. This here is your roadmap. Buy tech, buy oil, gold, silver. You buy it all in 98, 99, 2000, 2001. Now, some people are going to say when you bought it 98, 99, that complete bottom here and here, these two bottoms, they're going to say, oh, I can't handle it. It's not going anywhere. It's not doing anything. Now, 99, 98, that's when I graduated high school. And if I had done that in high school, even if I had put just some money in commodities and precious metals and stuff, over here, I would have been just laughing in 2008 and 2011, this double bottom here. And then if I knew what I knew now, I would buy tech. And then some people are going to say, well, it's not really moving because I'm buying it in 2009, 2010. And tech really didn't break out till 2011, 2012, 2013, depending on the tech companies that you're looking at. But if I held it all the way through about 2020 up here, I would have made, 10, 20, 30, 40, 50 times my money on this way down and this way up. Now we have to hold on to the commodity stuff because we're going to start another big bull market. This is exactly what we're looking for. Precious metals, gold is generally our leader. Then everything else will follow. Big opportunity, big opportunity. NASDAQ momentum versus gold is dying. So we're going to start to see the NASDAQ break out or break down against gold. This occurred, and we had a double top kind of there back in so this was 99, 2000 was the top. 2001 is when it really started to break down, and we're just starting to break down here. So he says a breakdown here would confirm the capital rotation event and give high confidence to a lost decade for stock markets and an enormous gold bull era. Also for commodities, this is when commodities rip. We can even see it in the fractal patterns in oil and other commodities. Copper's got a double bottom that we've broken out of, and it's starting to rip higher. I don't see how this doesn't play out. Like, I really would struggle to see how this doesn't break down and copper and oil and all these things just run. I'm positioned for it. I've been positioned in it. I've been buying all sorts of stuff. And again, that's what I share on the website is how to take advantage of this exact thing that we're seeing here of these breakdowns. North Star again, it says the pause in gold's biggest ever bull run ended a year ago. Very few people realize what this means. They will. This chart pattern told us it was simply a pause in even a bigger bull era. This pause is when technology stocks went up. It's also when interest rates went down. So it's when shale oil came on. So shale oil drove interest rates down, and it was a pause. Now, in shale oil, if we roll over, I think interest rates will go up. I think gold's just going to go to the moon. Uh, Silver is going to go to the moon. Platinum is going to go to the moon. Oil is going to the moon, and that's what I'm seeing. If you guys can kind of correlate this stuff, if you've seen enough charts, you can kind of overlay other things. But yeah, this is it's on its way. Baker Hughes rig count for February 7th, oil up one and gas up two, miscellaneous up one. So we're up 4 rigs, which is good. Rock bottom entries. The next 4 years under Trump, stocks are going to be down, commodities are going to be up, position accordingly. And this is a double bottom for the commodity index to the S&P 500 ratio. This here that we're looking at, this chart, is tied to this chart breaking down. They're all interconnected. Every single piece of data is suggesting that this will go up. And we're coming from a low level. Look how low we are. We've got a spinning top reversal. We've got basically a big double bottom. This is equivalent to 2000, and we're going to come off this bottom. This is going to be a double bottom. Boom, boom. Come on up, and then go and probably break even higher. Smart Real Estate Bet says opossums who claim there is no current housing shortage constantly point to the houses per capita measure. But it's a useless metric because household sizes have shrunk for the past 58 years. That's why household growth has outpaced that of the population by 67% since 1967. If they want to make a stronger argument, they should point to the ownership rate, which is in a typical range and in fact slightly above the 60-year average. There's a flaw in this argument too, though much harder to diagnose, and it is due to the way the Census Bureau calculates the ownership rate. The spike in 2020 gives it away. Any adult living in a home that is owned by the head of household is considered a homeowner. Adult kids on their own renting lost jobs and moved back in with mom and dad, making them homeowners for a year. From 1980 to number of adults living with parents was steady at 1719. Starting in 2005, that number started a 15-year surge, and it's very high. U.S. adults, children living with parents. Adult kids living at home are not homeowners, but they do represent future household and eventually homebuyer demand. Removing the surplus of kids at home from the homeowner rate tells us the real and very different story of where current ownership rates are, which are really low. And that's generally a good time to be looking at homes because they're going to come in and buy. It's future demand. Coming on back. We've got Howard Marks. The biggest investing errors come not from factors that are informational or analytical, but from those that are psychological. And that's where I think a lot of people mess up. They sell positions way too early. They don't know where we're located in this capital rotation event. They don't understand that this is going to last for a decade. They sell after 100% increase when you could have got a 10, 20, 30 bagger. That's where you make all your money, guys. So those big asymmetric bets that you let run. That's where Warren Buffett made the most. All of the big guys, all of them, every single billionaire guys, for the most part, they had a lot of money riding on a few companies that made a whole bunch of money over time, and they just rode that asymmetry to the dirt. They just never sell. That's how they make their money. Canadian venture micro cap stocks are getting ready to outperform the U.S. markets for a considerable period ahead, and that's that capital rotation event. Gold, silver, copper, lithium, battery metal, uranium, crypto, healthcare, AI. After a 4+ year bear market, a major bullish reversal is coming, and that's this S&P TSX Venture versus the S&P 500. So it's ready to rip here. I've got my stuff in some of this, not this Canadian microcap, but it's in some of the companies that are in Canada. Select ones that I really like. Gold, zoom out. We have a very long way to go. So gold, just looking backwards, when you get these capital rotation events, this is the Wilshire 5000 versus gold. We saw a breakdown here, and then this is the bottom where that circle is. We had another breakdown here, and that's the bottom. We have another breakdown that just occurred, but gold just broke out of this. So when we look ahead of us, we have a long way to go in gold, guys. We have a really long way. We have a long way to go in platinum, silver, oil. Like it's ridiculous to even think. Why do I think it's going to be that big? Because we have never seen the imbalance of how much money has been shoved into stocks versus hard assets ever in history. We're at the lowest ratio ever in 2020. And that's exactly why I was like, gotta get some, gotta buy. 2020, 2021, 22, I've been loading up in commodities the entire time, and now it's just starting to materialize. So we're going to start to see these things accelerate to the upside. People are not ready for this. They have no idea what's coming. And this is it's coming. It's right in our face right now. We're breaking through key supports on all these different metrics against gold. That's the first step. Now money's going to start to rotate. It's not going to go into bonds. It's not going to go into stocks anymore, or as much into stocks. And then they're going to start to look for returns. And those returns are going to be in oil. They're going to be in all of the stuff that we're in. And if you guys want to know the companies that I'm playing this with, this is what I'm doing. I am fine-tooth combing everything right now. I'm looking at all these different companies and all these different sectors. I'm looking for the largest asymmetric opportunities in commodities and in service companies everywhere in the world. Now, I'm not looking at maybe some of these overseas ones like Singapore or China, but I'm looking at the things in America, the things that have done well. I have historical data on last bull markets like this breakdown here of what did incredibly well. And then I'm creating a portfolio with huge asymmetry to capture this move. I don't need to win on everything because the asymmetry is so big. I just need to win on a good chunk of them. And the symmetry is going to carry me forward. And I have to have the cojones to hold through this bull market coming. And the sectors that I cover are gold, silver, platinum group metals. I cover energy, a lot of energy. So that's energy service, oil, nat gas, uranium. I cover steel, aluminum, copper, diversified metals, nickel. I cover shipping, all of that stuff. So tankers, dry bulk, kind of all of those areas. I think they have the largest asymmetry in those sectors that I just covered there. Josh Young says the global oil rig count is in decline, signaling higher oil prices will be required to sustain or grow production globally. And that's correct. We continue to see a decline in rigs. Is this a drilling boom? Is this what a drilling boom looks like? Drill, baby, drill, and we're undrilling? we're unrigging. Rig count's going down. Eric Nettle says checking in on the electric vehicles are going to cause oil demand to collapse. You know who said this in 2020? And I can't believe she's a professional. You know, she's running all this money, but Kathy Wood. I'm just like, no, oil's going to go through the moon. I don't know. Ford to take 5.5 billion loss on its electric vehicle segment. Porsche overhauls lineup to bring back combustion engines, and Nikola considers bankruptcy. Really, that looks really strong for EVs. So we've got a huge drilling boom where we continue to drop the rig count, and EVs are just taking off as Ford's taking losses, Porsche's bringing back combustion engines, and Nikola is going bankrupt. Eric Nuttall, one day when the market realizes that global demand growth is just fine, that drill baby drill is toothless, shale is meaningfully slow or slowing, and that OPEC spare capacity is not the challenge they think it is, then this chart will matter. Today seemingly is not the day. And we continue to go down in global observable oil inventories, down, down, down. This is when they released the SPR onto the market with hundreds of millions of barrels to suppress the price and control inflation. And here we are continuing to eat through that supply. I'm getting a little bit afraid here, guys, because I'm not afraid for my portfolio. I'm afraid that we're going to run inventories too low. We're going to get a big price spike. I don't want that to happen. I want oil to be stable. I want it to be $90, $100, $110, $120, $130 stable oil. I don't need price spikes. I want it to stay up there. I don't want boom bust cycle. I want 95 to 125 oil. That's just steady. Sexy women are everywhere. Successful men are not. You are the prize. Say that in the mirror. Hedgehog trader, inflation returns, CRB index versus the U.S. markets, S&P 500. In case it wasn't clear, now you've got to own exposure to commodities and hard assets, protect and grow your wealth. That's a breakout there, boys, for the commodity to stock ratio breaking higher. Looking good. And this is RSI breaks out of a 7-year base in 2021. Came back, and now we're breaking out again. This looks fantastic. Absolutely fantastic. January jobs, residential construction payrolls ticked up to new cycle highs. Yet, ex-government, healthcare, education, economy only added 14,000 jobs. All in all, soft, landish data. Soft, landish. This is not bad with construction payrolls ticking higher. That's a good thing. China air traffic, all-time highs in 2025, beating last year in 2024. Looking good. Freight futures AM update, dry bulk was up a little bit and tankers were down flat. Demand weakness, India, oil demand rose by 3.1% year over year. We've got diesel demand up 4.2%. These are all year over year. Gasoline is up almost 7%. LPG up 5.4%. Petcoke up almost 20%. And then naphtha down 12%. And aviation turbine fuel is up about 9.5%. So huge growth on year-over-year changes in demand for oil or fossil fuels. James Anderson says, wake up and smell the coffee, Silver Bulls. We've got coffee in 1-year performance up 129%. Silver's up 36, gold's up 31, orange juice up 27%. The USD is up 5%, if you'd like to know. And crude oil is up 6%. Crude oil WTI is up 7.5%. Platinum's up about 10%. So these things are going to start getting rocking here, I think. It's a silver squeeze, my friend. What this is he's showing the lease rates. Gold 1-month lease rate surges to highest in decades. This is how much silver is actually available to markets, and this is the 1-month lease rate in percent, just ripping. Absolute huge breakout in the 1-month lease rate in silver. And then we've got another one here. This is silver borrowing fees, or SLV borrowing fees, way on up. So looks like we are getting a little bit short of physical metals in the market here, and that's impacting lease rates. Here is Jorge, and that's already went over all that stuff. So we're going to end it there, guys. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. Specials, the coupon code. We have a midweek update. Question and answer session on Sunday, 5 p.m. Mountain Time coming up. And we'll see you there. See you guys.